Let's get to hot picks. Eric Nuttall, partner and senior portfolio manager at Ninepoint Partners, very kindly staying with us. Eric, thanks for giving us the time. And let's get on to some stocks. Baytex, we'll start with this one. It's been a long time favorite of yours, then Synovus, and then Nuvista. But remind us why you like Baytex. They did that big acquisition quite a while ago now in the United States.
You bet. Baytex has remained a long-term pick and a long-term laggard. I find the frustration level is epically high. People don't like the name because it hasn't performed. What people aren't seeing is we think at current levels, at $80 oil and $4 gas over the next 5 years, Baytex will return 95% of its current market cap through share buybacks and dividends. People are looking at the lack of share buybacks in the beginning of this year, saying, "Look, they're not walking the talk. What's that Nuttall talking about? Share buybacks, etc." For this company and many companies, they spend a lot in the first half of the year, so free cash flow is low, and then they harvest that free cash flow in the second half. That is exactly what is happening now, and so we saw Baytex be aggressive with share buybacks in June. We had them buying back $350 million worth of stock in the second half of this year, which equates to 9% of their shares outstanding. The stock trades at 2.4 times cash flow. That's one of the lowest multiples of any company that we can find when we think they have 12 years of stay flat drilling inventory. So it's not the 20, 30, 40, 50 years that some oil sand companies have, but 12 years is more than adequate. So with an equity or the stock trading at a 29% free cash flow yield at $80 oil, $3 lower than where we trade today, investors actively now getting half of that back in the form of share buybacks, we think the stock is massively undervalued. We think this stock should trade at 4 times cash flow. That's about a 12% free cash flow yield. That's almost a $10 share price, which is about 109% potential upside from current levels.
Are investors not happy with that big US buy, or why has the stock lagged, Eric?
We remain in a world where the energy sector has experienced negative flows. Energy funds have been redeemed, especially with the capital gains tax inclusion rate deadline on June 28th. So a lot of funds, I can speak from personal experience, we saw redemptions meaningfully increase leading up to that deadline. Energy's been has been the top performing sector in Canada. So if anybody's sitting on capital gains, the energy stocks suffered from their own success. We have now seen that trend completely stop. So there's been a lot of selling pressure in the energy sector due to that. That is now over. I think Baytex, we're in a sector where it remains out of favor. Generalists own 2-3 names. They own, CNQ, Tourmaline, and maybe a little bit of Synovus or something. They're just not willing buyers of SMIDs right now. And a name like Baytex, where it's had a little bit of hair, it hasn't performed well, it's not on the radar list. And that is just why the meaningful share buybacks that are ongoing as we speak are critical to get the stock to perform in the second half of this year.
Synovus, a favorite among oil sands investors. Why do you like this one, Eric?
Absolutely. After Baytex, we have them returning the second most of any company in North America. We have them returning 93% of their current market cap in the form of share buybacks and dividends. And again, that's at $80 oil. They're set to hit their $4 billion net debt target any week, any month now, at which point they'll inflect to returning 100% of free cash flow back to us, trading at a 13% free cash flow yield. It's heavily discounted against its Canadian peers and especially U.S. peers. It's a big theme of ours, whereas the dawn of U.S. shale becomes more obvious to the masses when U.S. companies have 5, 6, 7 years of stay flat inventory and Canadian oil sand companies have 30 years, 40 years, 50 years. Our names will, especially with the leadership change next fall, trade, I think, at a premium to U.S. names. So with Synovus trading at a 13% free cash flow yield, where we're about to get all of that going forward, trading at 4.4 times versus their U.S. peers at 8 times, we think the stock should be trading over $40 with about 60% or more of potential upside over the next year.
And then Nuvista, what attracts you there?
Yeah, so Nuvista is our favored way to get natural gas exposure while still getting meaningful liquids presence. They're ramping production from 85,000 BOEs a day to 120 over the next several years. At the current production level, they're trading at a 15% forward free cash flow yield, growing production by 10%, once they reach that plateau, they can keep production flat for 20 to 25 years. So it's a similar theme of an oil sand company, at which point I think they'll start returning 80, 90 to 100% of that free cash flow back. So here you have a company where we're trading at a 15% free cash flow today, trading at about a 22, 23% free cash flow yield in a few years' time, where they can pay us over 20% a year for the next 25 years before they have an inventory problem. So again, discounting trading versus U.S. gas names would trade at 7 to 8 times. This name's trading just above 3. We think a 5 multiple is fair. That's about a $22 share price, which is about 60% potential upside from current levels.